Understand how certain financial philosophies get baked into a company's DNA, you've got to look at the early documents. Today, we're doing a deep dive into the 1986 shareholder letter from Markel Financial Holdings Limited. You probably know them better today as Fairfax Financial.
Absolutely. And this letter, it's more than just a report card for the year. It really is the foundational blueprint. Our mission here is to pull out the core thinking. It covers this really explosive growth year in '86, sure, but more importantly, it lays down the rules for capital structure, for acquisitions, the whole investment philosophy that, well, still guides them. If you want the quick version of how they think, this is definitely it.
And 1986 really was the turning point, wasn't it? Markel Financial, before that, was pretty much just Markel Insurance, that one subsidiary. And they'd actually posted a loss, nearly $1 million in 1985.
Right.
Then, boom, 12 months later, this massive turnaround, record profits, and maybe even more critically, they achieved diversification almost overnight. That foundation was poured in '86. Let's just talk about the scale of it for a second. The company had never made more than $1 million before, ever. And then in 1986, net income after tax, $6.5 million. I mean, that's whiplash territory, financially speaking.
Oh, definitely. And it wasn't just the income statement. The whole balance sheet transformed. You can see
Yeah.
capital just flooding in and being put to work. Total assets, they jumped from about $41 million in '85 to $130 million.
Wow.
And shareholders' equity, that went from $10 million up to $41 million, quadrupled.
Which, of course, creates immediate value for the owners. That fully diluted book value per common share, it shot up 183%. Just soared from $2.08 to $5.89.
Yeah.
And think about it, coming off a losing year to then post an after-tax return on average common shareholders' equity of 25.4%. That's a pretty stunning performance. Shows real operational leverage, timing, something was clicking.
It really was. And the letter actually spells out why they thought it happened. They point to three main things working together. First, a huge increase in their main business, the trucking insurance. And they explicitly say they benefited because a major competitor, well, went under.
Opportunism.
You could say that. Second, a big part of it was fueled by fresh capital, that $20 million common stock issue we'll talk more about. And third, they made some really strategic acquisitions that right away spread out their risk. So yeah, it was kind of external luck meeting internal strategy.
Right, and that internal strategy piece, especially around that stock issue, that's where it gets really interesting because it basically set the course for the whole future of the company, didn't it?
Exactly. Let's look at the nuts and bolts of that $20 million public financing in July '86. They sold 2 million shares at $10 a share. But how they did it, that really shows the long-term thinking and frankly probably raised a few eyebrows at the time.
Because they didn't just sell regular common stock to the public, did they? They sold these things called subordinate voting shares, only
Yeah.
one vote per share.
That's the key. They sold the one-vote shares to the public, but management held on to the multiple voting shares, 10 votes per share for those. And the letter is incredibly upfront about why. They said, point blank, management wanted to keep control so they could manage the company purely for an above-average long-term return to shareholders.
Okay, so right away they're signaling long-term compounding is the goal, not necessarily what makes shareholders happy in the short run.
Precisely. It's a very clear message.
But that raises the obvious question, right? If management has all the voting power, what stops a big company from just offering a huge premium for management shares and leaving the public shareholders out in the cold?
Yeah, that's the risk with dual-class shares.
Yeah.
But they actually anticipated that. They put in a really important safeguard. It basically said, if anyone makes a takeover offer for management's high vote shares, that same offer, identical terms, has to be made to all the common shareholders.
Oh.
And they specifically mentioned wanting to prevent a Canadian Tire type situation, which they called very distasteful.
Right, that Canadian Tire fight was pretty famous in the '80s, where the founding family tried to sell their control block for way more than the public shares were offered. Caused a huge uproar.
So, yeah, they built in this protection against management getting a sweet deal that excluded everyone else. But, and this is important, they were still very clear. This control structure does mean an investor might miss out on what they called an attractive one-time bonanza. Big, quick takeover premium.
So the trade-off is explicit. Give up the chance for a quick buck for the potential of, well, what?
Yeah.
What was the grand prize they were dangling?
This is where the ambition just leaps off the page. They look straight at Berkshire Hathaway.
Wow.
They point to Berkshire's stock price going from $20 back in 1965 to At that time, $3,500. That's the benchmark. That's the aspiration. They're basically telling investors, look, we're keeping control because we want to try and replicate that kind of long-term compounding.
That takes some serious confidence to put in writing. To compare yourself to Buffett that directly and say, this is why we need control. But then they add that little dose of reality at the end, right?
Yeah, that crucial line. For Berkshire Hathaway, this is a fact. For us, it is only a goal. It acknowledges the huge mountain they're proposing to climb, sets the stage perfectly.
Okay, so they raised the $20 million after expenses. That left them with, what, about $18.4 million?
That's right. And they put $5 million of that straight back into Markel Insurance as extra capital. That left around $13.5 million, specifically for acquisitions. And they didn't waste any time putting it to work.
This is where the diversification really happened late in '86. Two key deals.
Exactly. First one, September '86, was Sphere Reinsurance Company of Canada. They bought it for $4 million cash and a $2.8 million note. So, boom, they're suddenly in the reinsurance business.
A whole new ballgame.
Totally different risk profile. Then, in October, they bought Morden and Hellwig Ltd. This was the biggest claims adjusting firm in Canada at the time. That was $2 million cash and, interestingly, $6.9 million worth of their own Markel Financial stock.
Using stock in the deal, that's significant given what they said about control. But more than the deals themselves, it seems like these acquisitions were used to lay down some ground rules for the future, weren't they? 4 core principles.
Yes, exactly. And these became really foundational. First principle, straight out of the value investing playbook, only acquire companies where good management is already running the show. They weren't looking for turnarounds, they wanted proven operators.
Makes sense. Buy the talent.
Second principle, and this is maybe the most famous Fairfax rule, the financial hurdle. They wouldn't buy anything unless they believed it could achieve a 20% return on capital.
20%. In 1986, that's a huge number to aim for consistently across different businesses. It's incredibly demanding. And the third rule reinforces that. Each company they bought had to be run independently, decentralized, but crucially measured rigorously against that 20% return target. So, autonomy, but with very clear accountability.
Okay, independence with a high bar.
Yeah.
And the fourth, that relates to using stock, like in the Morden and Hellwig deal.
Right. The fourth principle was crystal clear. Management views its stock as good as cash, period. Which means they weren't going to just spray shares around. They'd only issue stock in a deal if they were absolutely convinced they were getting at least as much value as they were giving up. Treat your own currency like gold.
So after laying out how they'd buy companies, the letter then kind of pivots to explain how they'd manage the money inside the company, specifically the investment portfolio. This seems aimed right in those new shareholders from the stock offering. Yeah, it's like, okay, you bought our stock, here's how we think about investing the float. And again, they're incredibly direct about their influences. They state flat out, the approach is based on the value approach laid out by Ben Graham and practiced by his famous disciple Warren Buffett. No ambiguity there.
So define that again in their terms.
Super simple, really. Buying stocks of financially sound companies when they're trading at prices below what they believe the company is worth long term. It's about finding bargains in good businesses, not trying to time the market.
And given they're mainly an insurance company, especially back then, protecting that capital has to be job one, right? You can't gamble with the money you need to pay claims.
Absolutely paramount. They explicitly say the first priority is protecting capital from long-term losses before even trying to make money. Safety first. And that philosophy dictates what they won't do, which is just as telling. They state very clearly, we do not speculate.
Meaning no risky bets.
Exactly. No options, no commodities, no futures, no gold, none of that short-term trading stuff. It's a fundamental rejection of trying to make quick profits through leverage or market timing. It reinforces that whole long-term compounding message.
And you could actually see this philosophy changing the portfolio in real time, couldn't you? The cash position, for instance.
Oh yeah, big shift. At Markel Insurance, cash and short-term stuff had been almost half the portfolio, 47% back in '84. By the end of 1986, down to just 14%.
Wow, that's a major move out of cash for an insurer.
It really is. It shows huge conviction that they were finding better long-term opportunities elsewhere. They were also careful with their bonds, keeping the maturity short, less than 5 years. Seems like they weren't keen on taking long-term interest rate risk.
So, less cash, shorter bonds. Where did the money go?
Into common stocks and convertible securities. They ramped that up significantly, about $43.8 million worth. This is them putting the insurance float to work, Graham and Bucket style, buying pieces of businesses.
Okay, so they made the shift. How did it work out in year 186?
Well, this is classic Fairfax humility, or maybe expectation setting. The total investment portfolio, with all these changes, was up 10.4% for the year. And how did they describe that result in the letter?
Let me guess. Amazing.
Uh,
Fantastic.
nope. A mediocre result.
Mediocre after shifting the whole portfolio.
Tells you everything about the high standards they were setting right from the start. 10% wasn't good enough, apparently.
Okay, so as the letter wraps up, they make the big structural change official, proposing the name change. Goodbye, Markel Financial Holdings Limited.
Hello, Fairfax Financial Holdings Limited. And, the story behind the name Fairfax is just one of those great little corporate anecdotes.
Yeah, where did it come from? Not some branding agency, right?
Not at all. It apparently came from Brenda Adams. She was the secretary for Keith Ingo, one of the key executives.
Oh, no kidding. A secretary came up with the name. What was her logic? Simple and brilliant. Fair, friendly acquisitions. Just summed up the whole ethos they were trying to build. So the board loved it, adopted it. Markel Insurance kept its name, but the parent company became Fairfax.
Fair, friendly acquisitions. I like it. Okay, so the letter's almost done. How does the chairman, Prem Watsa, leave things? What's his outlook?
He gives this really interesting perspective on the stock market, which kind of underpins why they felt comfortable deploying all that capital. He admits, I don't know where the market's going short term. Nobody does.
Right.
But then he looks back for context. He brings up the 1950s, points out the Dow Jones went up 5 times, from about 200 in 1950 to 1,000 by 1965.
Suggesting that kind of long bull run could happen again.
That seems to be the implication. He says he thinks there's a good possibility the Dow could rise significantly over the next 5 years. So, despite the day-to-day noise, there's this underlying long-term optimism about owning businesses, which justifies shifting out of cash and into stocks, and justifies pursuing those high-return acquisitions. #outro. So let's try and boil this down for you, the listener. This 1986 deep dive, it really shows you the crucible moment. This was the year Fairfax, or Markel Financial as it was then, really forged its identity. Tight management control was cemented. The value investing philosophy, straight from Graham and Buffett, was explicitly adopted. And that incredibly ambitious 20% return target became the yardstick for everything.
Yeah, it all clicked into place that year. And maybe the final thought to leave you with, a really provocative piece, comes back to that governance structure, that decision to sell subordinate shares to deliberately keep control in management's hands, even if it meant shareholders might miss a quick takeover payday.
Right, the choice they made.
Exactly. They chose the path they believed would lead to those unbelievable Berkshire-like returns over decades, even if it meant denying individual investors a potentially faster one-off profit. So the question to ponder is this: is that kind of structure, prioritizing long-term collective wealth, compounding over short-term individual opportunity, is that the ultimate, maybe the most difficult form of investment discipline a company can impose on itself and its shareholders? Definitely something to think about when you look at how companies are run today.